We go to chapter 19, partnerships. Introduction. He said, okay. The earlier chapters, 18 chapter, except chapter 18, related to businesses, which were owned by only one person, a sole trader. Another very common form of business is a partnership. A partnership is a business in which two or more people work together as owners with a view of making profit. So when we're talking about partnership, we're talking about a business set up by 2 to 20 people. That's the minimum, the maximum is 20. 2 to 20 people setting up a business, putting their investment into, putting their own capital into, putting their own money into the business with the aim of making profit. That's what partnership is. He said a partnership, the last paragraph now, said a partnership business will maintain double entry records in the same way as a sole trader. At the end of the financial year, an income statement and the statement of financial position are prepared. However, a partnership will prepare an extra account after the income statement, which is known as the profit and loss appropriation account. So we start with the advantages and disadvantages of partnership businesses. So, like I said earlier, partnership means 2 to 20 people coming together to form a business with the aim of making profit. They run account, the account they run is just the same account as the sole trader. They run the ledger account, they maintain the double entry record, and at the end of it all, they prepare an income statement and the statement of financial position. But what they do prepare afterwards is a profit and loss appropriation account. How they're going to distribute and share profits. That is what that account means. So now go to the advantages and disadvantages of partnership businesses. The first advantage is that additional finances are available. What does that imply? It implies that in partnership, a lot of, because it involves 2 to 20 people, that means they can contribute capital, they can contribute money into the business. Unlike a sole trader whose source of finance is just his own or her own personal savings. So in partnership, additional finance is available. 2, additional knowledge, experience, and skills are available. Because it's partnership, all partners have to contribute in terms of knowledge. They have to contribute their skills, their knowledge. They have to contribute it. Unlike a sole trader, where you don't have that. You are the only one taking decisions. You are the only one using your skills. And one of the problems about sole traders is that they might lack the skills, the knowledge to run the business. But because it's a partnership business, different people are coming together with different skills. So it could become easier for them because they can utilize multiple or multi skills in the organization. The third point here, the responsibility are shared. So unlike partnership, unlike sole trader, that you bear all the responsibility, here you share responsibility. There's what we call shared responsibility. So that means all partners work hand in hand. So all partners work hand in hand. That's what it means. So the fourth one, the risks are shared. In sole trader, you bear all the risk. But in partnership, the risks are shared amongst partners. The last point, there is discussion can take place before decisions are taken. Yeah, because they can collaborate, they can come together, they can have meetings before they take decisions. It doesn't happen in sole trader. A sole trader is the only one taking decisions. So here, a lot of people are coming together to take, before they have to agree on certain things before the decisions is taken. So what are the problems about sole trader? The first point here, profit has to be shared among the partners. So that means the profit sharing ratio, that means you won't be able to have all the profits yourself. But I've contributed a huge amount of money, but the profit is not it's not going to be huge because it has to be shared. Unlike sole trader that takes all its profit. The second problem about partnership is that decisions have to be recognized by all partners. So decision making, all partners have to agree before decision is being taken. So if one partner is saying no to that decision, the decision might not fly. The third point, decisions may take longer to put into effect. it takes time because maybe there's even conflict. So what it means is that before they put decisions into before they make decisions empirical, it takes time. It's not like a sole trader that can decide on everything and immediately get it done. Yes. In partnership, they might have to go through the partnership deed to check what the partnership deed talks about that decision. So things takes time. Second to the last, disagreements can occur because we are talking about different people with different ideology, different motives, different. Okay, I'll come back to them. Okay. So these disagreements can occur. Here we're talking about different people coming together. They have different ideas. They have different motives. Now, putting them together to agree on things might be difficult. One partner might disagree, and disagreement from one partner might mean that whatever decisions they have to take or whatever things they have to do might not go. So there might be conflict of interest. So what I like, you might not like. What you like, she might not like it. But we are partners. So that means we disagree on certain issues. Before the last one partner's action on behalf of the business are binding on all the partners. So if one partner makes mistake, it affects the whole partner. So the mistake of one partner affects all partners. And the last point made there, all partners are responsible for the debt of the business. So partnership is also unlimited liability. So the debt of the business can be transferred to the owners of the business. So each partners can lose even their personal wealth if the business runs into debt. Is it clear? So we go to partnership agreements. So when I talk about partnership agreement, we're talking about a document setting out the rules with which the partnership operations would go through. We call it the partnership deed or deed of partners. So it's a document stating the operations of the partnership business. Are you with me? Yes. So although it is not legally necessary to draw up a partnership agreement, when forming a partnership, it is advisable to do so. Drawing up an agreement can avoid misunderstandings and argument later. The clauses of a partnership agreement cover many aspects of the business. Those related to the accounting usually include the following. It is not binded by partners to make an agreement, but it looks logical and more professional and even ethical to have contracts signed, sealed by all partners, so that in the future, whatever decisions we take, we won't be saying, "Oh, we didn't know about this. Oh, I'm not agreeing on this. I didn't know. Why are you just telling me?" So the deed of partner talks about how the partnership business will go. So it's going to talk about the amount of capital involved. It's going to talk about how the profit is going to be shared. It's going to talk about the procedure of bringing in new partners. It's going to talk about partnership dissolution, when the partnership business could be over. It's going to talk about all these things. So these things are not things we can just imagine. They are things that should be written down so that everyone will have the evidence. So it won't be like, I don't know about this. Oh, she doesn't know about that. He doesn't know about it. That is the point there. So what are those things that the partnership deed will involve? One, amount of capital invested. So the amount of money you invest as a partner, the amount of money I invest as a partner, the amount of money each partner invested will be stated in the agreement, in the partnership deed. So partners do not need to invest equal amounts. Yes. So you might, because it is not a cooperative society, it's a partnership business. So you might have large amount of money than me, I might have than him, you might have than her. So it's not necessary we put into it's not necessary we put all the same amounts into the business. So one partner might have more money than the other. So that means when the share of profit comes, it will go on certain ratios too. The second item there is how profit and losses are to be shared. So profit and losses may be shared equally in proportion to capital invested or in some other ratios. So since we said it is not necessary that each partner puts the same amount of money, so it means that each partner would not be getting equal amount of profit. So profit might be shared according to their level of investment. I think that is clear. The third point, if interest on partners' capital is to be paid, and if so, at what rate? So the interest is a reward for investing into the business rather than elsewhere. If all partners invest the same amount, it will not be necessary to pay interest. Where the partners invest different amounts, interest can be paid, can be a form of compensation to the person who has invested most capital. So if partners invested more capital, they might, if we are investing additional capital now, that means the business needs more capital, and one of the partners is, is sacrificing for that, is putting that capital down, then it might be given an interest, it might be paid an interest on that capital to encourage him that, or to compensate him for, for putting more money, for more money into the business. But if additional capital is needed and each partner contributes almost the same amount, they might not be given interest. So interest might be given to one partner if it's contributing more than others. Do you get the point there?
Yes.
Talking about interest. If partner salary are to be paid, and if so, what amount? So here we're talking about active partners. Active partners are those partners that contribute capital into the business, and at the same time they are working in that business. So that means they have to be paid salary. So if they have to be paid salary, the amount of salary that they are going to get will be stated in the partnership deed. I think that is clear.
Yes.
If an upper limit is to be placed on partners' drawing, and if so, what amount? Yeah, we're talking about, because partners can contribute more capital into the business. At the same time, they can withdraw from the business. So if partners are going to be allowed to withdraw from the business, it will be written and it will be stated in the partnership deed. And at what rate will their interest be paid? It will be stated. And what amount will they be able to get? It will be stated in the partnership deed. If interest, they talked about it. So if partners, in the course of taking money from the business or goods for personal use, they have to pay interest, it will be stated in the partnership deed. I said that already, right?
Yes.
And the last one, if interest on partners' loans is to be paid, and if so, at what rate? He said, if extra finance is required, a partner may make a loan to the business to compensate for the loss of interest they could otherwise earn. Interest on the loan may be paid, or interest on loan may be paid. Like, there's a difference between giving a loan to the bank and adding capital to the bank. Capital is additional money to the business, but when you take a loan, that means you have to pay back the loans. Yes. So as businesses, as partners, you might decide to loan your company. So if you are giving a loan to your company, then it has to be decided if interest has to be paid on that loan or not, and at what rate. So these are all that it contains. These are all what partnership deed contains. Is it clear?
Yes.
So we go to loans from partners. A partnership may borrow money from one of the partners if extra finance is required, particularly if it's needed for a fixed period of time. Loans from partners are not part of the capital of the business and are treated in the same way as any other loan. Unlike investing additional capital, money lent to a partnership business by a partner will be repaid at an agreed time. Interest on the loan is a business expense and is not affected by the amount of profit or loss. Like I said earlier, in partnership business, if you are putting additional capital, you might be getting an interest. You might be paid interest.
Yes.
But the money, you might not get it back because it's inside the business already. But they know you have contributed it. But for loans, that means you've taken a credit facility. So for that reason, you have to pay interest on it. So if as a partner you are giving a loan, you are giving your business a loan, you have to agree with them when that loan has to be paid and the interest that has to be charged on that loan. Is it clear?
Yes.
So here he said, when a loan is obtained from a partner, what do? You debit the bank account and credit the loan partner X account. So if we're talking about the double entry system now. Are you there?
Yes.
So if you give me a loan as a partner, what you give, let's say You obtain, yeah, let's say yes, you obtain a loan from a partner. When you obtain a loan from a partner, that partner's account, you credit it, and your loan account, you debit it because you have received that loan from that partner. So when a loan is repaid to a partner, when a loan is repaid to a partner, what do? That partner account that you debited, you credited, you now debit the account and you credit cash or bank account.
Because you get it from the bank account.
Is it clear?
Yes.
So the loan could appears as a non-current liability in the statement of financial position. Interest on loan paid. When interest is paid on loan, you debit the interest on loan account, nothing to credit there.
Credit bank account.
Yeah, so you credit bank account. Yeah. Then interest on loan due to be due, but not paid yet. If there's interest that you have not paid, you credit that partner's account, that partner's current account, and you debit your interest loan account because it's not paid yet. Did you get it or not?
Yes. No, I didn't get it.
If interest is due to be paid, but it's not yet paid, that is what it means.
Yes.
So that partner that gave you that amount of money, you credit that customer's account. Then you debit the interest, or you debit the loan account where the interest has been taken until it's being paid.
Yes.
Okay, you get it now?
Yes.
So the interest on loan account is transferred to debit of the income statement at the end. That is an expenses.
Yes.
So go to preparation of profit and loss appropriation accounts of a partnership business. They said the profit and loss appropriation account for the financial year is prepared after the income statement and shows how the profit of the year is shared between the partners. So for the appropriation account, it's being prepared after your income statement, and it shows the share of profit between firms, within that firms. I think it's clear. Is it clear or not?
No.
When you have to prepare appropriation accounts,
Yes.
first you have to prepare your income statement. As soon as you prepare your income statement, your income statement will show the profit. Yes or no?
Yes.
So as soon as the profit has been declared, you need to prepare a profit and loss appropriation account, the account that the profit will be shared into. That is profit and loss appropriation account.
Yes.
Do you get it now, please?
Yes.
So the profit of the year is transferred to this account from the income statement. Any interest on joint charge to the partners increases the amount available to share, and this must be added to the profit. The appropriation the appropriation detailed in the partnership account agreement for interest on capital and partner salaries are deducted. The remaining figure is known as the residual profit and is shared between the partners in the agreed profit ratio. So what they are saying is this: as soon as profit is made from the income statement, immediately you have to prepare an appropriation account. So when you are preparing an appropriation account, you check if if partners have withdrawn from that account. If they have withdrawn from that account, they have to pay interest, right? The interest has to be added to the profit, which has to be shared. You get it? And that means because the partner has to pay interest, the amount available to that partner who has collected loan or who has made drawings will be less.
Okay.
When profit is declared, the business has made profit.
Yes.
The next thing is to prepare appropriation account.
Yes.
So for profit and loss appropriation account, what you have to do, you have to check the amount of money, the amount of income you make in terms of the amount of profit you make. So I will know the amount of profit you make, you put it in your appropriation account. How do you continue with that? Then you check each partner if they are owing the business or not. So if you are a partner and you traveled or you went to do something or you get something done, but you needed money from the partnership business, they will give it to you. But as soon as that is given to you, maybe you have to pay interest or you have to pay it back at a certain date. All these things have to be stated. So if you are getting a loan you debit the transaction.
I do with the partner.
If you are getting a loan for, if you are okay, yeah, if you are paying, let's say you got a loan. We said if you are getting a loan from a partner, you credit the partner, you debit that account.
Yes.
Great. So here, profit will be shared. But before they share profit, they have to put into consideration additional capital. They have to put into consideration drawings. So if a certain customer has added up, has put more capital into the business, he might be getting more interest. If one of the partners is a worker working in that partnership business, he will be getting salary too. Do you get it?
Yes.
So whatever the case might be, is either you are a partner that is active or a partner that is dormant. Do you get it?
Yes.
So let's look at the question here. They said, okay, Summit and partner are in partnership. Their financial year ends on 31st of May. They provide the following information. Capital on 1 June 28th. We have Summit at 40,000. Summit contributed 40,000. Partner contributed 20,000. Joint for the year ended. Summit had 11,000 in joints. Partner has 8,000 in joints. So profit for the year,
24,600.
it will be
24,680.
19,000. What?
24,600.
Yeah. So profit for the year they said is 24,680.
Yes.
So they said the partnership agreement includes the following terms: interest on capital is allowed at 5%. So that means they said interest on capital is allowed at 5% per annum. So each partners will have 5% additional on their capital.
Yes.
Interest on drawing is charged at 3%. Interest on drawings. Are you with me?
Yes.
So if there's interest on drawings, that means if you have withdrawn a certain amount of money from the business, you have to pay.
So it's plus 3%, not less.
If interest.
Yes, interest.
If they said interest is charged for 5% on your capital.
No, that's yeah, on capital.
Yeah.
On drawing, but on drawing is less.
Interest on drawings is charged. You let drawing from capital, but the interest will be added. The interest, they said interest on drawings. Let's say you took $30. So if interest is 5% of $30, that means you're going to pay $30 with the 5% of $30. So you add the interest to the amount of drawings you took. That is what you are going to pay.
Yes.
Do you get it or not?
Yes, I get it.
I'll say it again. There's interest. Interest is either paid on capital or drawings, right? Good.
Yes.
So if it has to be paid on drawings, that partner that has withdrawn that amount of money, the amount of money will be deducted from its account. Is it clear?
Yes.
So partner is entitled to a partnership salary of 9,500 per annum. Residual profits are shared in proportion of capital invested. So partner is entitled to partnership salary.
This shows partnership and
that means partner is an active partner. So we check. So to prepare it, they said the profit for the year is 24,680. That stays there. Then we had interest on drawings. For Summit, how much is it? For interest on drawings for Summit, they say it's of 3%, right?
Yes, 3%.
3% of the amount. Interest on drawings for partner, 3% of that amount. You add them together, you add it to your profit for the year. I think that is clear.
Yes.
Then you less interest on capital. For capital, what do you have? We have for Summit, which is 5%. For partner,
5%.
For partner, which is also 5%. So 5% of that amount is 2,000 and 1,000. So that's what you add together. So profit for the year plus drawings minus capital. Minus capital, yes.
Minus salary.
That is if we have salary.
Yes.
So now we go to partner's account. It's only partner that has salary. Yes or no?
Yes, partners. Yeah, only.
9,005, yes?
Yeah.
So you add it up. So that gives you 12,500. So 12,500 minus 25,000 is 12,750.
Yes.
So the profit made is 12,750 after all expenses are paid. So the 12,750 has to be shared among the partners, which was stated that the share of profit is.
There's the calculation here.
No, I'm talking about, did they give us the amount of profit that we have to share?
No, they did. They did the calculation. Split it up between both. Under the.
No, what I'm saying is they said something. They said the residual profit are shared in proportion to capital invested. Is there? The residual amount is shared based on the capital invested.
Mm.
Do you get the point there?
Yes,
so the capital invested is how much? The total capital invested is 60,000.
Yes.
Listen, please. Here they didn't give us the share of profit, maybe 10:20. No. They didn't give us ratio for the share of profit.
Oh, yeah.
Rather, they said we should share the profit based on the residual, based on the amount of capital invested. The total amount of capital invested is 60,000. The profit made is 12,750. So to do that, Summit, how much did Summit contributed? Summit contributed 40,000. 40,000 out of the 60,000 capital contributed,
Yes.
multiplied by 12,750. Partner contributed 20,000 out of the 60,000, multiplied by 12,750. That is the amount of profit they're going to get.
Yes, I get.
Is it clear?
Yes.
So to prepare the profit and loss appropriation account, I think it's easy. Profit for the year, you had capital, and you had joints, and you less capital. If there's partner salary, you add it. Then you less the amount from the total amount you have. That would be your profit share. That would be the profit you have to share. If the ratio is being given, you use the ratio to share the profit. If the ratio is not given, that you have to use the residual profit, then you divide the amount contributed by each partner divided by the total amount contributed multiplied by the profit. Clear?
Yes.
So we go to partners ledger accounts. So for partners ledger accounts, it's similar to a sole trader. Each member of the partnership businesses has their own capital account in the nominal ledger. This usually record permanent increases or decreases in the capital invested by the individual partner. Capital accounts prepared in this way are referred to as fixed capital accounts. So a capital account has a credit balance as business owes this to the partner. So when like just the sole trader, that you have different suppliers account or customers account.
Yes.
Same, you need to open the nominal ledger for each partner. So as soon as the partner puts money into the business, that means there's capital into the business. So the business is owing the business is owing the partner. So you have to open a capital account, which means you have to credit the customer's account. Credit customer's account. Capital. It's capital account, you credit it.
Yeah, credit capital. And debit the partner account.
Is it clear?
Yes.
You debit the partnership business account, not the partner's account. Each capital account for partners has to be a credit bar because the partner is giving out money to the business.
Yes. That's only one point.
Yeah, so that's for capital account. Then we have the current account. This is where transaction takes place. They said each member of a partnership business also has a current account. Anything which the partner becomes entitled to, such as interest on capital interest on loan partner salary and profit share is credited to this account. So for the current account, this is where money comes in or go out of the partnership account. So if each partner has share of profit, it goes into that account. If there's interest on capital, it goes to that account. If there's interest on drawings, it's taken from that account. I think that is clear. So anything which the partner is charged with, such as drawings and interest on drawings, is debited to this account. So interest on drawings and drawings are debit balance in the current account.
The current account, yeah.
Yes, because in the capital account, capital is a credit balance. Clear now, right?
Yes.
So a credit balance on the current account represents the amount owed to the partner, and the debit balance represents the amount owed by the partner to the business. So whatever the business is owing
Mhm.
the partners in the current account, it's going to have a credit balance. And whatever the partner is owing to the business will be a debit balance. Like drawings, like interest on drawings.
Yes, yes.
These are things that you are owing the business now. So it's going to be on the debit balance. It's going to be a debit balance. I think that is fair.
Yes.
Okay. So if current accounts are not maintained, interest on capital partners' salary, profit share, drawings and interest on drawings are recorded in the capital account. That is, if the partnership business are not or do not have a current account, they can use the capital account for all the preparation of
But if
accounts.
they don't have the capital account,
No, you wouldn't.
you
The capital
wouldn't.
account is where the business starts
Oh,
from.
yeah.
Is it clear?
Yes.
So now we go to drawings account. Here they said drawings account. A drawing account is maintained for each partner. The total of this account is transferred to the partner's current account at the end of the financial year. So here we have Summit and Partner.
Yes.
In partnership, their financial year ends on 31st May. They provide the following information. Capital account 40,000 here. We talked about current account. Each has a current account of 130 credit and 910 debit. So,
Yes.
are you getting it?
Mm-hmm. So, Summit, what's her name? She owes.
Yeah, Summit is owing the partnership business, and Partner,
The partnership
the business is owing Partner. I think that is clear. Okay. So for the year ended 31st May 29, drawings amount to 11,000, 8,000, interest on drawings 330, 240, interest on capital,
Mhm.
partner salary, partner is the one that is active,
Yes.
then share of profit is stated. So now they say we should prepare the capital and current account for Summit for the year ended.
Yes.
So to prepare the Summit account for Summit and partner account, so we prepare Summit capital account. For Summit capital account, you credit the amount Summit is putting into the business.
Balance.
That's Summit.
Mhm. Summit.
You credit that account
So then
for 40,000.
you have this. This one. Is it there or no?
Prepare the capital account. You said you should prepare it. Yes. I'm explaining this now.
Oh, yeah.
Okay. So the first thing we have to do is the capital account has to be prepared. For the capital account, what do we have in the capital account? 40,000 for Summit, which will be a credit balance, and 20,000 for partner, which will be a credit balance. That's the first thing. I think that is done.
Yes.
So we can continue doing Summit accounts. So let's finish Summit accounts. They said Summit has drawings of 11,000.
Mhm.
Now, let's take Summit. Let's prepare Summit's account. First, we prepare Summit capital account. So the next thing is Summit's current account. So for Summit current account, in the debit side of the current account, we're going to have drawings and interest on drawings. Yes or no?
Yes.
Good. For the drawings, 11,000. Interest on drawings is 330,000.
Yes.
And they said, based on what we have here, Summit is owing the business $130. So that will be a credit. Credit balance, $130. It's there already.
Yes.
The interest on capital, they have interest on capital, be on the credit side. Profit sharing will be on the credit side. So you add them together, you take it away from the debit side.
You get the balance.
That's the
Brought
balance
down.
carried down.
And brought up on the next thing.
Yes. You get that.
Yes.
So the credit balance, the interest on capital, profit sharing, you take it away from the drawings and interest on drawings.
Mm.
That is Summit account. Then, they said, using the information below, prepare the capital and current account for Summit and partner for the year ended. So,
That's, yeah, pardon, I think so.
yeah, this is capital account for Summit and partner. We are preparing together now.
And you have also current account for both.
Yes.
Yes.
So, if you are preparing them together,
Mhm.
you have Summit and partner. The capital account, it's still going to be on the credit side
Yes.
for the same amount. Yeah. So now the current account, for the current account, what are those things that's going to be in the current account? The same transactions that we've done for Summit, interest on drawings, the balance, if it's a debit balance on the debit side. And the credit side, we have the credit balance, the interest on capital, the salary, the profit share. Then you add them together, you take them away from each one. Summit from Summit account, Padma from Padma's account.
Yes, I get it.
Do you get it now?
Yes.
So as soon as this is done, we can now prepare the statement of financial position of partnership business. Do you have any question about that?
No, it's easy.
Clear, right? Okay, great. So they said a statement of financial position of partners is the same as that of sole trader, with the exception of the capital section. So this must show that the capital account and the current account balances for each partner separately. It is not necessary to show all these details in the transaction affecting the current account. It is adequate to show the closing balance on each account. So we just have to show the closing balance. So here, so this is how we extract the statement of profit and loss. We have our capital account for Summit.
Yes.
Summit put 40,000 into the business. The current account, Summit is owing 700. Yes or no?
Yes.
You take it away. Padma puts 20,000. The business is owing Padma 20,000. You add it up.
Yes.
Do you get it? Credit balance will be taken away from the capital account. Debit balance will be added to the capital account.
Yes, yes.
So the total is there. I think it's clear.
Yes.
Now they said Summit and Padma are in partnership. Their financial year ends on 31st of May. Their current accounts are this. So we have 40,000, 20,000. The opening balance, interest on capital, partner salary, profit share, less drawing, and interest on drawings. All is done. These are an extract of the statement of financial position. So that's here they prepared the statement of financial position real now. So capital account will have its own. The opening balance, which is 130 for Summit, 910 owing to Padma.
That's for the business.
No, yeah, it's owing. The business is owing Padma now.
And the first one, the previous one was about.
That is just an extra for capital and current account. Now we're talking about extract for the whole account, for the whole transaction.
That's for the business.
Yeah, so that's the statement of financial position.
Because I was like confused. Why this?
Did you get it now? The first one is the extract for the capital account and the current account, where you have to add, where you have to deduct the credit and you have to add the debit.
Yeah.
Now the extra, the capital account, the amount of money invested. The current account, what are those in the current account? We have our opening balance, the interest on capital, the partner's salary, profit share. All these you add them together, then you less drawing and you less interest on drawings.
And that's it.
And that's it.
Yes.
Is it clear? Any question about that? So let's see if we can answer this one. So let's quickly answer question 1 and 2.
Yes.
The time is up though. They said Cindy is a sole trader. She's considering forming a partnership with Laura. What is the disadvantage of being a partner?
Professor share. See.
Profit are shared, yes. See. Question 2. Which item may appear as deduction from the profit of the year for the year in the appropriation account?
Drawings, yes, interest on capital. So it's A.
Drawings,
Interest on capital.
interest.
Yeah.
Which items may appear as deduction?
Deduction, yeah. Drawings is one of them. Drawings, so it's either A or B. Drawings is one of them.
Interest on capital is not a deduction, it's an addition.
No, I mean. So how? But because look at this. If we choose A or B, because drawings is a deduction, right?
I'm with you.
Drawings is a deduction. So if we choose either A or B, it has to be interest on capital. Because drawings is one of them.
Drawing is one of them.
Must be, yeah. So it's either
interest on capital invested.
Or
wait.
Yes.
They said which item may appear as deduction from the profit for the year in the appropriation accounts of partners. Yeah, it could be to the business or to the partners.
Yeah.
So drawings, interest on capital, interest on loan.
Yes,
so it's B.
Yes.
Question 3. How and Kwan are partners? How capital is 100, Kwan is 50. The partnership agreement provides for interest on capital is 3% per annum, and annual salary for Kwan is 6,000. Profit and losses are shared in proportion to the capital invested. The profit for the year is 18,009. How much was credited to Kwan's current account?
I have a pen. I'll do it.
Okay.
Easy.
Yeah, sure.
I'm guessing. So